Welcome to The Explainer. Today, we're cutting right through all that shiny marketing hype to look at the ground truth, the high-stakes reality of being a fintech product manager in 2026. We're living in an era where digital banking isn't just an option, it's the absolute norm. And the folks actually building these products, well, they're navigating a landscape that looks nothing like traditional consumer tech. So we're going to uncover what it literally takes to survive and thrive in this incredibly complex space. Let's get right into it.
So let me ask you something kind of provocative. If you know how to ship a slick new app feature, does that automatically mean you can run product at a bank? A lot of people in the broader tech world think so. They assume a great PM can seamlessly jump from a social media app right into fintech. But here's the reality check. Hiring committees for top digital banks are actively rejecting candidates who think fintech is just, faster banking. It's not about brainstorming flashy UI features anymore. It's about deeply, deeply understanding the massive financial engines running underneath the hood.
The answer to that question is absolutely not. And to show you why, here's exactly what we're going to cover today. We'll start with the 2026 landscape, untangle the strategist versus tactician roles, and look at constrained innovation. Then, we'll tackle the elephant in the room, legacy mainframes, before wrapping up with the new outcome-based success metrics you actually need to care about.
Okay, Section 1. The 2026 FinTech landscape. We really need to set the stage for the environment we're operating in today.
Digital is simply no longer an alternative. To put this in perspective, in markets like India, digital payments have hit a staggering 99.8% volume. I mean, that is basically the entire market. Digital-first finance is the absolute default everywhere. Globally, we're looking at a fintech market projected to cross $420 billion by 2029. Customers expect onboarding and transactions to happen in minutes on their phones. But, and this is a huge but, behind that seamless digital facade is an incredibly complex operational reality. Moving to Section 2, strategists versus tactician roles. As this landscape scales, a lot of confusion pops up about who is actually building what.
Which brings us to the great debate. Do you need a product manager or a product owner? Getting this wrong can literally derail your entire roadmap. It stalls go-to-market timelines and creates massive friction between product and engineering. You absolutely have to know which role you're hiring for. Because in fintech, where regulations and user demands shift at lightning speed, role clarity isn't just a nice-to-have, it's essential for survival.
Okay, there is a very hard line here. The product manager is your strategist. They own the why and the what. They're figuring out market fit, commercial viability, and getting all the cross-functional teams aligned. On the flip side, your product owner is the tactician. They own the how and the when. They're embedded right there with the engineers, managing the backlog and turning user stories into actual tasks to keep delivery velocity high. Basically, building from scratch, you need the strategist PM. Already got a roadmap and just need to execute fast? You need the tactician PO.
All right, Section 3, mastering constrained innovation. Now that we know the PM owns the strategy, let's look at the actual battlefield they're strategizing on.
This is where the job completely breaks away from your standard consumer tech playbook. In regular tech, you optimize for engagement, growth at all costs, right? But in 2026 fintech, you are optimizing for survivability. You operate under what we call constrained innovation. It's this dual mandate where you have to grow user value, but simultaneously minimize the surface area for regulatory penalties and systemic risk. Your ability to contain failure is actually your most important KPI.
Let me give you a real-world example of this. UDAAP, which stands for Unfair, Deceptive, or Abusive Acts or Practices. Say you ship a slick one-click savings feature. In one actual case, doing this boosted opt-ins by 37%. Looked like a massive high-five around the office win, right? Well, actually, they didn't consult compliance. It was flagged as a UDAAP violation and rolled back instantly. You don't just own the roadmap in fintech, you have to steward it through massive layers of regulatory control. And that right there is exactly why hiring committees reject folks who just want to build shiny apps. As one hiring manager brilliantly put it, if they don't know how the balance sheet moves, they'll ship features that break the business model. If you see a money transfer as just a user journey, you're going to fail. You have to understand it as a sequence of hold states, reserve allocations, and FX triggers. Just look at the numbers. Out of 14 product manager roles recently approved at a Tier 1 digital bank, 9 of them, 9, were for core banking replatforming, not consumer apps. The real hiring boom isn't about making a prettier mobile interface, it's about modernizing infrastructure to meet regulatory mandates and managing general ledger impacts.
Which brings us to Section 4. Let's talk about navigating legacy mainframe tech, the biggest elephant in the room. A lot of the digital apps we use today are just a modern coat of paint over incredibly old technology. When you compare nimble neobanks to legacy incumbents, the gap is just staggering. A cloud-native neobank with fast APIs can push code tens of times a day, every single day. Meanwhile, incumbent banks are stuck on 40-year-old COBOL mainframes and rigid ledgers. They used to aim for one release a quarter. Now they're lucky if they manage once a month. And the financial cost of this tech debt is mind-blowing. It costs incumbent banks around £150 per customer just to maintain their IT estate. Compare that to a neobank, where it costs just £20. Incumbents are bleeding money just to keep the lights on, because every new feature added to a 40-year-old core adds a compounding, messy layer of complexity. So why not just fix it? Well, fixing it means migrating undocumented code that's been buried for decades. Industry experts literally describe the risk of upgrading a core banking system as a brain transplant or switching out the plane engines while flying. It is phenomenally expensive and incredibly risky, which is why banks have avoided it for so long. But they just can't afford to ignore it anymore.
This legacy burden really rears its ugly head when we talk about reconciliation. The old 24-hour back-office batch cycle, it's totally dead. It's being replaced by the unforgiving latency of real-time networks like FedNow, SEPA Instant, and UPI. The real opportunity for PMs today is surviving this transition from batch to real-time settlement without accidentally triggering a systemic failure like a false overdraft cascade.
Section 5. Outcome-based success metrics. Because the stakes and the tech are so different now, the way we measure success has completely evolved. We have to totally throw out the old playbook. Honestly, nobody cares about your vanity metrics like app downloads or raw signups anymore. What they care about are outcome metrics, things like audit trail completeness and net retention rate, or NRR. Agile velocity, replaced by audit pass rates. And if you want budget for your team, you don't walk in pitching a net promoter score, you pitch your exception rate reduction. That's what gets funded. And let's talk about acquiring customers. If you think your customer acquisition cost is low, keep this number in mind. KYC and AML compliance alone adds $5 to $25 per customer. That is before you even spend a single dime on marketing. Fintech CAC is just structurally higher because these mandatory regulatory costs are baked right in. When you actually factor in those compliance costs, plus a massive 30 to 60% onboarding failure rate, your true, fully loaded CAC is easily double or triple what the marketing team claims. It's such a common pitfall. A CAC that looks like $40 on a sign-up dashboard quickly becomes $120 for a fully funded active customer. Getting that first funded account is the metric that actually matters. So how do you actually survive and thrive here? You need operational humility, you need risk fluency. That's what gets you the job over a polished pitch deck. You must be able to map your features directly to their general ledger impact. You have to study payment rails like ACH, FedNow, and Swift. You need to master incident postmortems and control docs. And above all, you have to fluently speak the language of risk and compliance. I'm going to leave you with this final thought to challenge how you approach your day-to-day. In the 2026 fintech landscape, are you just building features to drive engagement, or are you engineering the controls that keep the bank alive? The choice you make there completely defines your reality as a fintech PM. Thanks so much for joining me on this explainer, and I'll catch you next time.